Okay, so get ready because today we are diving into a true classic, Benjamin Graham's The Intelligent Investor.
Yeah, this book is really like the investor's Bible.
It's packed with wisdom.
And not just from Graham himself, but updates from Jason Zweig and a preface by Warren Buffett.
I mean, come on.
It's legendary.
Legendary is the word.
And what's remarkable is how relevant it still is.
Oh, absolutely.
Even though it was first published decades ago.
It's timeless.
It really is. And it's not just for Wall Street hotshots, you know?
No, not at all.
It's for anyone who wants to approach investing with a clear head and a long-term perspective.
Exactly. And what we're doing today is like getting a multi-generational view.
Yeah.
Because we've got those insights from the original text, Andy, the newer commentary.
That's like a 2-for-1 deal.
Right. So if you're listening and you're looking to really get a handle on investing, I mean, Graham gives you that mental framework.
He really does.
To cut through all the noise.
All of it.
And make those smart choices.
Which, let's be honest.
Oh, I know.
It's tough in a world obsessed with quick wins and following the herd.
It really is. And it can be so easy to get caught up in all of that.
Absolutely. One of the biggest takeaways from The Intelligent Investor is that when it comes to investing, your biggest enemy can be yourself.
Oh, tell me about it. We've all been there checking our portfolios every 5 seconds, panicking when things dip.
Exactly. Graham actually talks about this actress, Barbara Streisand.
Oh, yeah.
She once said she couldn't stand to see red in her portfolio, meaning she'd sell any stock that dropped in price, even for a little bit.
Oh, wow. Talk about letting your emotions drive the bus.
Right.
I can totally picture someone like that hitting the sell button the second their portfolio dips even slightly.
It's a perfect example of what not to do, and it highlights this key point that Graham emphasizes throughout the book.
Yeah, which is?
Emotional discipline matters just as much as, if not more, than any fancy financial knowledge you might have.
It's so true.
Yeah.
It's like you could read all the books, study all the charts, but if you can't keep a cool head when the market takes a tumble,
you're doomed.
You're more likely to make impulsive decisions that hurt your returns in the long run.
100%.
So are there studies on this? Have they actually looked into that?
There was this fascinating study, actually.
Hey.
It found that the people who traded the most frequently actually had worse returns than those who barely touched their portfolios.
Really?
Yeah.
That's wild.
It's crazy, right?
I guess it makes sense, though. Constantly reacting to every little market fluctuation is bound to backfire at some point.
Exactly. It's like trying to catch a falling knife, you're more likely to get cut.
Ouch.
Graham is all about taking a long-term approach, riding out those inevitable market ups and downs.
So how do we avoid getting caught up in the frenzy and making those emotional decisions? Does Graham offer any advice on that?
He does. One of the most powerful tools he gives us is a look at historical market data.
Okay.
Remember Table 3.2 in the book? It shows stock market performance over a century.
Right, the long view. It's easy to get caught up in the day-to-day drama,
Yeah.
but zooming out can provide some much-needed perspective.
Exactly, and what that table reveals is incredibly important. It shows that despite all the short-term craziness, the crashes, the bubbles, the corrections, the market has consistently trended upwards over the long haul.
Okay, that is reassuring. It makes those scary headlines about market dips seem a little less terrifying.
For sure.
But is it really that simple?
Well,
Don't those market indices sometimes paint a rosier picture than reality?
that's a great point, and Graham addresses this too.
Okay.
He talks about something called survivorship bias.
Survivorship bias.
Imagine you're looking at a photo of a marathon's finish line, and everyone looks happy and accomplished, right? But what you're not seeing are all the runners who dropped out along the way.
Ah, I see. So it's like those indices are only showing us the winners, the companies that survived and thrived.
Exactly.
We're missing the full picture of all the investments that didn't make it.
Precisely, those indices are still useful, but we have to remember they don't tell the whole story. And that's why Graham stresses the importance of not just blindly following the market, but understanding the businesses behind the stocks you invest in.
Which can be tough.
Yeah.
Especially for someone just starting out who's maybe never even looked at a financial statement before.
Right.
So we talked about keeping our cool when Mr. Market throws a tantrum in the last part.
Right.
But how do we actually go about building a solid investment strategy? Does Graham offer any guidance on that?
He absolutely does, in fact.
Oh.
He outlines 2 distinct investor profiles in the book.
Okay.
The defensive investor and the enterprising investor.
Okay.
And he tailors his advice based on which profile you identify with most.
I love that. It's like he's saying, investing isn't one size fits all. Tell me your style and I'll guide you accordingly. So for our listener, which type resonates more with you? Are you team defensive or team enterprising?
It all depends.
Yeah.
It comes down to your personality, your appetite for risk, how much time and energy you're willing to put in.
Right.
Defensive investors are all about minimizing risk and preserving their capital.
Okay.
They're looking for steady, reliable returns, even if it means sacrificing some potential for explosive growth. Think of them as the tortoises of the investing world. Slow and steady wins the race.
I can see the appeal in that, especially for someone who's just starting out or doesn't want to spend all their free time analyzing stocks.
Right.
What kind of specific advice does Graham offer for our defensive investors out there?
He's a big advocate for diversification, especially for this group. He suggests allocating at least 25% of your portfolio to bonds.
Okay, so bonds are good for the defensive investor.
Think of bonds as the anchors of your portfolio.
Okay.
They provide stability and balance, especially when the stock market gets choppy.
It's like having a financial safety net, right?
Yeah.
Knowing that even if the stock market takes a nosedive, you've got something solid to cushion the fall.
Exactly. And for those who prefer a truly hands-off approach, he recommends index funds.
Index funds, okay.
They offer built-in diversification and can be a great option for those who don't want to spend hours researching individual stocks.
Plus, with index funds, you're basically hitching your wagon to the performance of the overall market.
Right.
Which, as we've seen from that historical data, tends to trend upwards over the long term.
Precisely.
As long as you're patient.
And here's another key strategy Graham emphasizes for the defensive investor: dollar cost averaging.
Dollar cost averaging, okay.
Imagine you're buying your morning coffee. You don't wait for the perfect price, do you?
No.
You just buy it regularly, regardless of whether it costs a few cents more or less on any given day.
Yeah, that's a great analogy. I've always found the concept of dollar cost averaging a bit hard to wrap my head around.
Yeah.
But that makes it so much clearer.
It takes the emotion out of it.
So instead of trying to time the market,
Right.
you're investing a fixed amount at regular intervals no matter what's happening out there.
Exactly. It's like setting your investments on autopilot.
I like that autopilot.
It prevents you from making rash decisions based on short-term market fluctuations.
Oh.
Plus, it ensures you're buying more shares when prices are low and fewer shares when prices are high, which can really benefit you over time.
Makes a lot of sense. It's like a disciplined approach to investing that takes advantage of market volatility without requiring you to become a day trader glued to your computer screen.
Yeah, you don't have to be watching it all the time.
No more refreshing your portfolio every 5 seconds.
Exactly.
So what about our enterprising investors, those who are willing to roll up their sleeves and potentially take on more risk for the chance of bigger rewards? What does Graham suggest for them?
Well, we'll have to save that for the next part.
So we've got our defensive investors covered.
Right. Those who are looking for steady returns while minimizing risk.
Right, but what about those more adventurous souls?
Ah, yes, our enterprising investors.
The ones willing to roll up their sleeves, dig a little deeper, maybe take on a bit more risk for the chance to uncover.
The hidden gems, exactly.
Exactly. What's Graham's advice for those folks?
Well, for our enterprising investors, Graham encourages exploring what he calls secondary companies.
Secondary companies.
These are often the smaller, lesser-known businesses
Okay.
that might be flying under the radar of Wall Street analysts.
Ooh, intriguing. It's like those treasure hunters scouring for rare artifacts.
Right.
Except in this case, we're searching for undervalued companies with the potential for big returns.
That's the idea.
But this approach probably requires a lot more research and due diligence, right?
Absolutely, you got it. It's not just about picking a name out of a hat.
No.
Graham emphasizes the importance of really understanding the business, analyzing its financials, and determining its intrinsic value, what it's truly worth.
And that takes time, right?
It does.
Because even if you find a fantastic company, it might take a while for the market to catch up and recognize its true value.
You're right. Patience is key here.
Patience.
Remember that company Graham talks about, Burton-Dixie Corp?
Burton-Dixie Corp rings a bell.
It's a classic example of how patience can pay off for the enterprising investor.
Ah.
The company wasn't exactly a household name, but Graham recognized its potential and held on to his shares even when the market wasn't giving it much love.
And what happened?
Well, the company's value eventually soared, proving that sometimes the biggest rewards go to those who are willing to wait.
It's like that saying,
What's that?
the stock market is a device for transferring money from the impatient to the patient.
I love that.
Right?
It's so true.
But of course, there's a flip side to every coin. While Graham encourages enterprising investors to seek out these undervalued opportunities, he also warns against falling into the trap of overpaying for so-called glamour stocks.
Right. He uses the example of the dot-com bubble,
Yeah.
where investors got caught up in the hype and ended up paying exorbitant prices for companies that ultimately couldn't live up to the lofty expectations.
And crash and burned.
It's a cautionary tale about the dangers of blindly following the crowd and ignoring those fundamental principles of value investing.
It's like going to an auction and getting so caught up in the bidding frenzy that you end up paying way more for something than it's actually worth.
Exactly. And Graham offers this brilliant way to avoid falling into this trap, his famous concept of Mr. Market.
Mr. Market, I've heard of this guy.
Picture this, a business partner who shows up at your door every day offering to buy or sell stocks. The catch.
What's the catch?
His prices are all over the map, driven by his ever-changing moods.
So it's like having a business partner who's prone to extreme emotional swings from euphoria to despair.
Exactly.
I can see how that would make it difficult to make rational decisions.
Precisely. And that's the point. Mr. Market represents those irrational swings in the market, driven by fear, greed, and everything in between.
So how do we deal with this Mr. Market?
Graham's advice: don't let him dictate your moves.
Okay.
Use his volatility to your advantage.
Okay.
When he's feeling manic and overpaying, sell to him. When he's depressed and undervaluing assets, buy from him.
It's like having a secret weapon, knowing that you can outsmart the market by staying calm and collected when everyone else is losing their heads.
Exactly. And that's where another key Graham concept comes in: the margin of safety.
The margin of safety. Okay.
He advises buying stocks for significantly less than their intrinsic value, giving you a cushion to absorb those inevitable market fluctuations.
It's like having that financial buffer.
Exactly.
A safety net to protect you from those unexpected bumps in the road.
And Graham provides a real-life example of this with Aetna Maintenance Co., later known as Hayden Switch.
Aetna Maintenance Co.
Right.
What happened there?
This company's stock soared in the 1960s based purely on speculation and market hype, even though its underlying business fundamentals didn't justify that sky-high price.
Oh boy, and then what happened?
The bubble eventually burst, and the stock came crashing back down to earth, leaving those who ignored the warning signs and bought into the frenzy with significant losses.
Ouch, that's gotta hurt.
It's a stark reminder that even in a bull market where it seems like everything is going up, it's crucial to stay grounded in those fundamental principles of value investing.
So basically, don't get caught up in the hype.
Don't get swept away by Mr. Market's emotional roller coaster.
As we wrap up our deep dive into The Intelligent Investor, what's the most important takeaway you hope our listener walks away with today?
You know, at the end of the day, I think the biggest lesson from Graham is that successful investing is less about intelligence and more about temperament.
Oh, that's interesting.
It's about mastering your emotions, having the discipline to stick to your strategy, and remembering that the market is not your friend.
Oh, no.
But rather that manic depressive business partner named Mr. Market,
Right.
whom you can outsmart by staying cool, collected, and always seeking that margin of safety.
Right. I love that. Such a powerful image to keep in mind. So for our listeners out there, remember the wisdom of Benjamin Graham, and may your portfolios always be well protected by that all-important margin of safety.
Here to that,